Good morning, traders. Today is December 10th. This is the MENT Rotational Modeling System update and real estate update. This is the third of 3 videos that I do every week for you, on top of updates during the week and trying to keep you informed of how to better protect, manage, and grow your wealth. Right now, the MENT Rotational Modeling System is dang close to reaching new highs. I updated this as of the end of November, just a week ago. Markets were poised to break to new highs. Now they've rolled back sideways this week. And this is kind of what I expected. If you've been following me every week, I try to tell you what to expect in the markets, how to protect yourself, and how to grow your wealth. So right now we're going to go over the rotational modeling system, the historical stats. You can see that we've been growing slightly in a kind of a sideways manner. We're just below $2 million after starting with $100,000 back in 1996. We're going to probably roll to new highs and higher next year. So it's going to be a very exciting year. This year, the big news is the fact that we are off only 0.6%, while everybody else is looking like they're going to be off somewhere between 20 and 40% in terms of hedge funds, managed funds, and others. So this has been a very stable year for the MENT Rotational Modeling System. And like I said, by the end of the year, depending on what happens, we could see a change before the end of the year. And I kind of expect the markets to bounce near Christmas, and maybe traders kind of jump into a 2023 trend before 2023 actually hits. So now let's go this way and show you the current setup. Now I've increased the allocation of stocks going into the end of the year to 20%. Reason being is the TT scanner models are moving into bullish trending, and I've highlighted the strength in the mid caps, in the Dow Jones, in consumer staples, and I believe that we're going to see some real opportunity moving into 2023. I don't know where you guys are at out here in California. It's a little cold for California. Sometimes we normally get into the 70s, 80s, 90s out here at this time of the year, but right now we're in the 60s, into the 40s and 30s at night, so that's a little cold for California. But shopping is, it looks like it's really picking up. I was in the local shopping mall a couple days ago, and I can tell you from being on the road lately, it looks like everybody is out shopping. I think the Q4 numbers are going to come in, especially for the holiday, a lot stronger than people expect. And I think we're going to see a nice little rally into early next year if the Fed, again, if the Fed doesn't come out and try to surprise. So where we're at right now is for the primary allocation model, we've got 20% stocks, 55% cash, 25% metals, and metals have actually started to perform very well as a hedge. You see gold and silver have moved back to bullish and daily. And still zero in bonds. We're not seeing, although bonds have recovered a bit, 16, 17%, TLT has, we're not seeing a big upward trend yet. We're not seeing that fear yet drive into bonds. So this 20% stocks here gives you the ability to play and to take some token positions potentially between now and the end of the year. And again, we're seeing things like healthcare continue to move higher. We're seeing things like, in fact, let me come over here and come over here and here. We're seeing strength in a number of different sectors, but if you take a look at this, let me resize this real quick. Drag this over this way. Still need to resize it a little more. Okay. So this is the main TT scanner list. You can see here that gas explorations, energy trust, and aerospace defense are long and bullish. But notice we're seeing accumulation here in the semiconductor industry. We're seeing bullish trending in medical devices. We're seeing bullish trending in home construction. We're seeing bullish trending in exponential technologies, XT. We're seeing bullish trending in global infrastructure. We're seeing bullish trending in raw materials. We're seeing trending in consumer staple stocks, accumulation in global tech, bullish trending in U.S. Jets, JETS. We're seeing bullish trending in healthcare. We're seeing bullish trending in gold miners. We're seeing bullish trending here in miners. Global natural resources. We're seeing bullish trending in healthcare, in biotech, again, biotech, and down here in Amex Industrial Select and aerospace and defense. So what we're having is we're getting kind of an early stage accumulation basing phase, and I want traders to be able to take advantage of some of these setups on the TT scanner as they're playing out over the next week, let's call it 5+ weeks, because I believe the markets are going to be setting up for a very solid trend to the upside. And I've highlighted this chart here, which is again a little too wide, so I will try to shrink it into view for you. And you can see here that we actually have a fairly solid, move this up, fairly solid base setup off of this wave 5 potential bottom. We could move either direction here. We could see weakness into the year, possibly setting up a bottom near 21st, 22nd, possibly of December, maybe a little later. Then maybe a bit of a rally. You can see this little arc, that is circle ellipse that I've drawn here. But I believe we're going to see a fairly solid base back over here, and we're possibly going to be at not new all-time highs, but we're going to be above potentially 4,100 on the SPX before the end of the year. We will see. I'm seeing strength right now more than I am weakness. We could be setting up kind of a basing bottoming formation here. We could see a bit of a downturn over the next 5, 6, 7 days, but I really think we're going to see some real strength in the U.S. economy throughout the end of the year and into 2023. Okay, so we are at 20% stocks, 55% cash, 25% metals, and 0% bonds. Alternately, we're at 20% stocks, 80% cash, 0% bonds, and currently our position is still bearish. Weekly is 25% allocation is still bullish. We're at 23% profits in this position. This is for 2 accounts. This is how I run the rotational modeling system. And we are 75% bearish, and we are net 1.66% profit in this position. Combined positions, we would be at 50% bearish, 50% cash, and that would put us in a scenario where from August 31st, we would be up 1.6%, and we are holding this position until anything changes. So again, the rotational modeling system is weekly bullish 25% allocation and daily bearish 75% allocation. Combined, we are daily, weekly bearish at a 50% allocation and 50% sitting in cash. Now, the real estate market gave some pretty interesting flat numbers last week, so I'm going to show them to you here. Price reductions continue to climb. We're up above 100%, so everything on the market is declining. Active listing count has flattened out. Prices continue to drop. Days on market are climbing slightly, and price reduced share has increased. Got a little blip here to the upside. What's happening overall with the modeling system is the modeling system is kind of flattened out right down here. You can see it's not moving massively like it was last week or a couple weeks ago. We were getting minus 2.4s, minus 3.2s, meaning that it was weakening considerably. Right now, it's very flat at 43.5. So this is the pricing factor is decreased again from roughly 23 down to 43. That's a pretty big drop, guys. And the model market demand is minus 36.96, meaning that real estate is really really tough right now. It's kind of a flat, dead market right now. The price trends index has flattened back out. You can see here it's gotten a little positive over here. And I want you to be aware that this is still carryover of the strength in the market. We're not seeing huge reductions yet. We may, into next year, see a bigger drop in price reductions. Real estate price reduction activity is now at near all-time highs. You can see it's up near 100% here and climbing over here on reduction activity. You can see active listings change. Now we've reached the highest level of active listings in the past 2.5, 3 years. Pretty important to understand that listings are starting to stack up. Inventory on the market is starting to stack up, and we have our new listing counts here. New listings are at a new high, highest level we've seen in 4 years. New listing count change is positive, and new listing share of market is flattening out. Now, this is, like I said, share of market is a measured account of whether or not we have a flood of new listings hitting the market, and we haven't seen this really move to the upside considerably. Next, we have the heat rank. The heat rank had a bit of a blip. Now, what happened here? You ask yourself, what happened? A couple of weeks ago, we had a drop in mortgage rates, and that caused the heat index to weaken. So in other words, drop in interest rates means certain people were trying to take advantage of the drop, and you can see that the drop in interest rates over the last couple of weeks had this little pop. Prior to that, we were moving into a very weak market trend, and we'll see how it plays out. The Fed's going to come out with a rate announcement before the end of the year. Next week, actually on Wednesday, I believe it is. So we will see how this reacts on Thursday. The tightness ranking had collapsed considerably. You're going to see this waffle around until we enter a trend. We had gotten down into this minus 60, minus 70 area. Now we're back up to the minus 20 area. This is the tightness. So in other words, the market became very weak over the last 3, 4, 5, 6 weeks, then tightened back up over the last week or two. And again, this is likely because there's not a whole lot of activity taking place right before Christmas. I can't imagine anybody's looking forward to trying to move in this cold weather and right before the holidays. We'll see what happens as we move into January. Inventory strength is tightening back up. That is again related to this heat rank. The heat rank has moved back up, so the market's getting a little hotter. That means that inventory strength is going to get a little stronger. And lastly, we have seller desperation, which is fairly flat and to the downside. So we're not seeing real desperate sellers yet. So heat rank is at 4.56%. Tightness is up 30%. This is in the last week. These are the moves that we've seen. Inventory strength is up 2.72%, and seller desperation is down 7.87%. So the market's gotten into this flat, sideways, price reduced mode, waiting for the Fed and waiting for new buyers to come along and really drive the market higher. What I found very interesting was the increase in active listings here. Active listings have gone incredibly higher. We've seen a very big shot of inventory into the market, the biggest shot of inventory into the market in many, many years. You can see right here, this is the largest number of new listings that we've seen flood into the market in a long, long time. And I think this is just getting started. I think this inventory number could potentially be, 40, 50, 60% higher by mid 2023. And we'll see what happens with the Fed and see how it plays out. So again, you've got all of this available in the members area of MENT.com. I've tried to provide these videos for you. And remember, in January, I'm going to be making changes to the website, providing more resources and more information for active users. So I want you to be aware of the changes that are coming. Visit MENT.com, follow me on Twitter and YouTube. Share this research with your friends. Remember, the rotational modeling system back over here is the key element to trying to protect and grow your wealth. I don't know where you can get this type of success with any type of a long-term rotational retirement type of a modeling system And this is bulletproof, ladies and gentlemen. This is adaptive technology, which is designed to adjust to market trends. Yes, it is rules based, but it is built around proprietary adaptive learning technology. So it's got quite a bit of opportunity going forward for you. And the next 4 or 5 years, we should see a really big increase here. We should see this right now. It's averaging about 260% performance compared to the SPY. Over the next 4 or 5 years, I would imagine we're going to see an increase up into the 310, 315 percent comparison to the SPY. And boy, when volatility hits, that's when the rotational modeling system really kicks in. Okay, so again, follow me, share with your friends. We're getting a couple of weeks into Christmas here, and get ready. We're going to have some really interesting trends. I'm kind of thinking this is going to set up somewhat similar to 2018, meaning bottoming and starting to rally possibly just before Christmas, like days before Christmas, and we'll figure out if it happens, and I will alert you as we move forward. All right, guys, talk to you later.